Hey, what's up, good people? How you doing? Welcome back to Stock Up with Larry Jones. Market is tanking today. Why is the market tanking today? We're going to discuss that and a few other things, but first make sure you hit the like, subscribe, and the notification bell and come join what we call the family. All ages, all sexes, all races. Anything I say is not a suggestion for you to buy, hold, or sell. And lastly, don't fall for spam in the comment section. I have to say that on everyone because there's a lot of naive people out there. Why is the market tanking? Why has the Dow fell almost at this point 550 points? Well, here's why. U.S. service industry regains steam. Factory orders accelerate. That means, of course, that they went up. What is that data? That's called the ISM. All right. This is the ISM numbers that came out today. Let's read. ISM Manufacturing Index, formerly known as Purchasing Managers Index, PMI, and I believe the PMI numbers are coming out this Friday, calculates manufacturing activities based survey conducted every month by Institute for Supply Management, ISM, of purchasing managers from more than 300 manufacturing companies. So out of these 300 manufacturing companies, they pretty much their orders, their activities, right? So just like this said, if it regains steam, meaning this is back up, that could be a sign to the Fed that what? Inflation is still here. And so that's why we have to understand the whole picture. This ISM report from November just came out now, and it is showing that, hey, inflation may still be running hot. So what does that do? That scares the market because the market is scared of, I was going to say Uncle Ben, of Uncle Powell, right? Jerome Powell, the Fed. So that's a sign that it gives the Fed more room to raise interest rate hikes. So now, is the boogeyman going to give us 50 basis points? Or is he going to give us 75 basis points, right? Is daddy going to whoop us? Is just going to tap us 3 times? Or is he going to take the belt and really give us a tanning? That's what it amounts to, really. And so that's why the market tanked. The market giveth, the market taketh away. The Fed giveth, the Fed taketh away, unfortunately. Let's look at the Dow. Let's look at these indices. As we could see, they're down right now. Let me refresh it. All right. So the indices are down right now. Okay, the Dow is fighting. No, it's not. Boy, that was a trick. So everything is not good. All right. Everything is around 2% negative. The NASDAQ, S&P, and the Dow. No telling where it would be by closing bell. So let's look at the week. Remember Friday when Jerome Powell blessed us last week? As we could see, we're up, but barely up. You know, here's last week's activity when we had that run and then we had a sell-off, right? And look at this. It's almost back to where we were before, except the NASDAQ. The NASDAQ is still hot, on fire. The NASDAQ had more room to make up, of course. And so that's what's happening, all right? So that's what's going on. I want to talk about another stock area that's performing well today. But before we do that, I have to do this because it is MooMoo Monday. As we could see, MooMoo upped their game. Now you get 10 free stock for depositing $100. See here, 9 plus 1 is 10. And you can get up to 20 free stock if you deposit even more, right? It's MooMoo Monday. It will be the top link below. Let's keep it moving. So I want to talk about what I talked about last week, and that's ADRs, these Chinese ADRs. As we could see, they're doing well. And they've been doing well. They're still doing well today, even though the market is down. But these Chinese stocks are doing well. And if you look over the week, they've performed well. Look at that. Insane. And the entire month, they're doing well. Look at that. Insane. Pindu here at the bottom, 42% up in the last month. Look at double digits on all of them. So if you're into the Chinese ADRs, you're making a killing. Now, myself, I do option plays when it comes. Like I said last week, when it comes to these Chinese ADRs, myself are just not touching Neo. And I know some of you are in it. It's not doing well. You guys saw when I tapped out last year, I made a big announcement, took a lot of flack. Why? And these are in the same boat. But I just get more price action on these when the Chinese government says, hey, we're going to release our zero COVID. We're going to ease our zero COVID restrictions. I do option plays. I make calls that they're going up. And I've done that numerous times. But soon as I think things are about to peak out, like I believe they are now, if you're green in these, if I was green in these, I'm not going to tell you what to do. Anything I say is not a suggestion for you to buy, hold, or sell. But me personally, I would be taking profits. That's what I would be doing, because we do know that the Chinese government and President Xi literally yo-yos from week to week. And so they could turn around and go the other way very quickly and very abruptly. All right. And so that's how I'm personally playing these. So be careful with the Chinese ADR. Listen, I want to discuss this. Let's give a listen for a minute and then let's discuss it.
The market reacts poorly, but then we get like a normal recovery, which is what I think we need.
But if you think that the market is supposed to see out 12, 18 months, the question is, when's that?
If we all know it's going to happen, why is the market still here? I know. I think part of it is just the fact that we're approaching year end. I would get ready for a very volatile January. I think the higher the market goes in December, the worse it's going to be in January. But I do think there are places to be. So the key risk right now is not being invested in any equities. Right. I think you need to pick your spots. Right. But I don't think that
unless you believe that maybe 18 months from now, by 18 months from now, it actually is better, meaning there is this trough you're talking about, but that what the market is actually looking at is something, much further down the line.
Sure. And if you have an 18-month time horizon, I mean, if you have a longer than a year time horizon, I think you should remain invested and maybe potentially add exposure to sectors. I think if you have a 3-month or a 1-month or a 6-month or even a 12-month time horizon, it's hard to say we're going to clear where we are.
We could go 3,600 to 4,300 for like 2 years, couldn't we?
True.
Theoretically.
I mean, I think we're setting ourselves up for a better long-term bull market. No, I think one of the reasons that I think we could actually see long-term gains over the next 10 years is that our valuation framework, which is the most predictive model over a 10-year time horizon, explains 80% of the market's variability over a 10-year time horizon, is telling us we're going to see 5% returns per annum over the next 10 years. Now, if you add on to that a 3% dividend yield, 8% total returns, reinvest that puts the S&P at 9,000, the price equivalent, in 10 years. I mean, the market looks like it could double over the next 10 years if you just remain disciplined, reinvest your dividends. I think we're sort of moving back to a more old-fashioned equity market.
So what are the sectors?
So I absolutely agree with her. My stance hasn't changed. I don't care how we end this year. I don't care if we have a Santa Claus rally or a Christmas rally. I don't care if we go 42, 43, 44. I believe it'll be somewhere around 41, the S&P 500. It doesn't matter. She aligns exactly what I see. And remember, what I see may not be right, but I do see that we're going to fall off. And I do believe the higher we get this year, the deeper the fall. Of course, the higher the run up, the deeper the fall, because the reality is still coming that we are due for a third leg down or a harder recession in 2023. I personally believe not only is it coming in the first half, but the first quarter-ish. OK, I could be wrong, but I agree. Now, I may not be right. This is, some of you are going to say, hey, you're trying to time the market. You got to make a plan. But what I'm saying is, I agree with her, is it doesn't matter. If you make your plan and stick to your plan, you just have to be disciplined, because I'm in this for a minimum of the next 10 years, right? Just like she said. And I do believe once it comes down, that's when I'm going to buy more aggressively. But just in case, for a safeguard, I'm still continuing my dollar cost average, right? And I'm going to continue that all through 2023, just like I did in 2022, all right? But when it comes to buying big chunks of stock that I believe in, and you guys know that I am going to be loading up on blue chip stock. I want more of my portfolio to be in the bigger blue chip FANG and tech, but I'm going to wait till it absolutely tanks. Okay. Yes, I'm going to get back into some Tesla and those type of plays. I'm going to load up on those, and I'm going to hold those for the next 10 years. You have to develop a plan. Now is the time for me in the next 30, 60 days is you should be setting up long-term investing and not be overexposed to day trades, okay, or swing trades. That's what I suggest. What do you think? Do you think we're at the bottom? Do you think we have totally averted a harder recession? Do you think we're out of the recession, or do you agree with what I see for the future, right? Yes, we could have a Christmas rally, but just like this woman said, the higher it goes, the further we have to drop off, all right? Hey, make sure you check out those links below, especially MooMoo. It is MooMoo Monday. Click the top link, leave me a comment, and let me know what you think. Live, love, laugh, and learn.